road journey with Shri Dinesh Khara, former chairman, State Bank of India, and this session will be moderated by Madam Latha Venkatesh, Executive Editor, CNBC TV 18. Could I request you both to please take your seats on the dais? Let us welcome with a resounding of claps Shri Dinesh Khara, former Chairman, State Bank of India, and Madam Latha Venkatesh, Executive Editor, CNBC TV 18. Welcome, ma'am. Welcome, sir. And with that, I hand over charge of this session to Madam Latha Venkatesh. Over to you, ma'am.
It's such a pleasure to be able to speak to Mr. Khara again. And my guess is the answers are going to be different because he will be able to cast his eye over a near 4 decades of Indian banking when he participated in leadership positions. So, Mr. Khara, thank you very much for this opportunity yet again to be able to speak with you. Well, as you look back, what's the biggest transition you see in Indian banking?
Thank you, Latha. Well, of course, I think as far as the Indian banking is concerned, it has really transformed into absolutely digital, leveraging more and more analytics, which was never the situation in the past. We all used to have huge database, which was all static. Of late, we're in a position to run various algorithms. So I think as Indian banking has actually evolved itself into a very, very sound banking proposition and perhaps comparable to best in the globe.
Oh, that's right. Let me start there then. Mr. Khara left SBI at probably at the crest of its glory. In fact, not just SBI, the banking system at the best of profits, nearly 80,000 crore. And the banking sector itself at the lowest in terms of NPAs, 2.8%. In my reporting career, I have not seen as good a number as that. What's your sense? Are we at the top in terms of margins and profit and at the bottom in terms of NPA? Do you think the cycle is on the cusp of changing, not worsening, but I mean, we can't have good times all the time.
Well, I think in the history we have seen a couple of accidents as far as the financial sector is concerned. One, of course, was 2008 global financial crisis. Then perhaps in the year 2014 when the AQR came in. And I think considering the fact that in the Indian financial system, banks have played a significant role in terms of building up the asset,
Mm.
identifying the stress in the balance sheet and providing for it at that kind of a scale was never envisaged.
Mm.
And having done that, perhaps it was a bitter pill which was taken by the system. And a lot of transformation happened in the ecosystem. One among them was the IBC, which came into existence. And I would also say that there was more responsible borrowing which started happening. And that is one of the reasons why perhaps the twin balance sheet challenges could be resolved. So having come to a stage where as far as the stress which was there in the system, it was addressed. And also banks also resorted to much better risk management uh, over the years. So that is something which I would say that it was a major transition which happened. And thanks to the ecosystem and the internal practices of the bank, we have come to a stage where the kind of numbers which you indicated in terms of gross NPA and also the net NPA actually came down. And the learning in this whole process is that if at all banks are in a position to do the underwriting, which is perhaps the best in quality, they need not provide for it. And if at all they are not required to provide for it, then perhaps their ability to generate profit
Profits is high.
goes up multiple times. So this is learning.
Mm.
But yes, of course, we all know that the ecosystem does not remain
Okay.
as it is
Okay.
seen perhaps in the best of the situation.
Mm.
And very often it is said that the accidents happen during the best of the times also. So I think one thing is very clear that the banking system has started understanding the risk in good time. and providing for it. The mitigation, which is now being adopted by the banking system, thanks to the uh, analytics which is available, they're in a position to do some kind of a
Mm.
predictive behavior. They can read. Early warning system is something which is available. And these are the kind of contributory factors which gives an impression that perhaps we are going to have, as far as the credit quality is concerned, that should not be a challenge.
Okay.
But yes, of course, there could be other risk,
Okay.
which perhaps could one of the other risk which I can envisage is the interest rate risk.
Okay. No, I'm coming to that. You've raised several issues: the quality of loans, the digitization, and the ability to do better due diligence, and cost of money. So let me come to the cost of money. If I take a vote, I mean, I don't know how many people here are below 40. I don't think any of them will have an FD. The migration away from FD is done. Do you think this is a structural shift in the cost of money?
Actually, Latha, when it comes to the preference for an asset class, it is getting guided by the perceived notion in terms of the
Return.
return.
That's right.
So that is something which is a reality. Having said that, I must also mention that we have done some analysis in the bank, and we could see that almost about 57% of the deposit is there from about 20% of the deposit come from less than 40 years of age bracket, fixed deposit,
20%.
20%, and 37% comes from 40 to 60% of the age bracket.
Oh,
So it is 57% of the deposit is still being contributed by people up to the age group of 60.
people who have not retired.
Yeah, people who have not retired. So they are still active. So I think it is more of an asset allocation. People do opt for various kind of instruments depending upon their yield preference and also their risk perception. So it's essentially a risk return trade off which people really
Mm.
resort to. And normally it happens that when the markets do so well, at times people don't get to see the risk which are inherent in the
Yes, yes.
markets. But yes, if at all you will look at it over a long term, these are the aberration which happens at a
Mm.
point of time
The very fact that people are comparing mutual funds and FD is a mistake. I hope those who are doing the comparison are also recognizing the fact that you're getting steady returns in mutual funds over the last 4 years.
Yeah.
But there was also a 2019 and 20 when we did not get those
No,
returns.
that's why asset
That should be
allocation
understood.
principle holds good.
Mm.
Something in the fixed income, something in coupons, something with the market related return. That actually helps in broad basing the risk return profile also, and also improve the earnings on the savings as
Mm. But uh, to come back to the position of banks, you also gave, I think, over 3.5 margins once. You gave even 3.6 in one quarter. And now, of course, it's 3.35, the last one, the last quarter that you gave. Do you think the best of margins is behind you? I mean, look, I think HDFC Bank is 8.2 or 8.1 for a category of, FD. And I think today I saw somebody else giving 7.9, one of the PSU banks, I mean, giving 7.9. So, is it a problem that is going to persist for a year, or do you think it's structural that banks are stuck with higher deposit costs?
well. No, actually, we have done some analysis which is actually based on the RBI report, where we have done some analysis over a time period, and we could get to see that generally the deposit advances divergence, it persists for anything from 25 months to 41 months. So our assessment is that maybe this divergence perhaps would last somewhere in the June to
Okay.
October quarter.
Okay.
So what you mentioned in terms of the ability to sustain the NIMS, well, I think when it comes to deposit interest rate, of course, different banks, depending upon their ALM situations and also their credit deposit situation, they will have the compulsion of raising deposit at a higher cost also. But much of it will depend upon their asset liability composition and also their credit deposit ratios. So if at all they have got the flexibility in terms of their credit deposit ratio to defer the increase in the interest rate, perhaps their ability to support the NIM would be much higher.
Mm.
And if at all, uh, and and also with the lower credit deposit ratio, they can actually decide the portfolio relating to their portfolio as well. They can actually
You
look
mean
at
pass on the cost?
pass on the cost and also look at the higher yielding assets also.
That
So
is, I was waiting for you to say that you will pass on the cost. Now, let us look at the people who are going to take that higher cost,
no,
sir.
actually, not really passing on the cost, because why I'm saying that passing on the cost, because see, eventually, if at all you are looking at the best quality assets, your ability to pass on the cost is also limited.
Hmm.
So this is
Good point.
something which has to be kept in mind. So essentially, it's a very fine balancing which is required to be done by a banker. One, of course, they cannot trade off in terms of the quality. And if at all they cannot trade off in terms of quality, they have to look at the very fine pricing. And how should they really arrive at that is something which is a skill.
Yes, of course. That's the banker's skill. But are you worried about asset quality? The Reserve Bank Deputy Governor was there, your former colleague, at the CNBC TV 18 function, and he said that there isn't anything worrisome about asset quality. But nevertheless, risk weights were raised, and there are NBFCs who tell us that at this point in time, 10% of the total NBFC borrowers have 10 lines of credit. I mean, the over leverage of a small section, maybe. I mean, obviously, the other 90%, he himself must be saying is, properly leveraged. But are we in a state of over leverage in retail, not in corporate? Corporate is absolutely unleveraged, deleveraged.
In fact, that is perhaps the reason maybe RBI had the visibility of such kind of a behavior. And that is one of the reasons why perhaps they increase the RWAs. So naturally, by increasing the RWAs, the cost of fund for such entities have gone up. So this is the other way of discouraging such entities to go for the unsecured in an unbridled manner. So that is, I think, it is coming out of that. So I would say that RBI action was well in time
Ahead of the
and
curve. Yeah.
much ahead of the curve, and probably it was a adequate signal to the system that better as you strengthen your underwriting practices. So I think from that is the role of the regulator, and they have performed it
Yeah,
pretty well.
I agree with you that it was, they smelt the rat earlier than
True.
the industry itself, perhaps.
Yeah.
But, sir, is there still? I mean, let me persist with this just for a little bit more. MFIs, we already know, are in trouble, and we saw that in the first quarter numbers of many of the smaller microfinance companies. Even in retail, it's a very crowded trade. Nobody else is borrowing. Corporates are seriously deleveraged. They are managing their capex with internal accruals, and market rates have gone down because of bond inclusion, and US interest rates about to go down. When have we last seen the 10-year under 7%? So, CPs are available for companies at fine rates. ECBs are available because of global, Eurobond rates. So banks are left with what? The overcrowded retail rate. Everybody is there. P2P lenders se leke SBI tak. The whole range is only crowding on retail. So are you worried that this overcrowded trade is leading to poorer quality of borrowers getting
No,
loans?
again, here again, I would say that when it comes to the, if at all you are looking for a quality borrower in the, even in the retail segment, you have to be very mindful in terms of the risk, I mean, price which you will charge. If at all, uh, we have seen the huge variety in terms of the retail lending also. And we have seen that there are entities where even the gross NPAs are much less than one, and there are entities where the gross NPAs are quite high too. So depending upon the choice of customer whom they have picked up, and naturally, when the cost of credit is on the higher side, their ability to, I mean, they are trying to have part of the cost recovered through such borrowers. But yes, of course, I think the very important underwriting principle in case of retail borrowing is also to look at the EMI to NMI ratios and also the asset creation which happens. So unless if I mean those are the cardinal principles of lending which should not be compromised. And if at all people are in a position to stick to those underwriting principles, I think they're in a position to maintain the quality and also the earnings.
Okay. I'll revisit this in a different avatar just for a wee bit. But I want to come to this a whole buzz on digitalization. We've done excellently well when it comes to payment. No country ahead of us. We are second to none. Now, let's come to ULI, the Unified Lending Interface. How close are we, sir?
No, I think as a bank, we had started going for the digital lending, particularly in the SME and the agri space. And that was essentially we were trying to leverage the ecosystem where the land records were all digitized, where when it comes to GST invoices, we were in a position to have an access to the GST invoices, etc. So we came out with the business rule engine, which was 5 lakh to 5 crore, that kind of a lending. And the intention was essentially we were riding on the success of the threats. But there's a slight difference when it comes to threats. There is a product is already made available to the customer, and they have accepted the bill. So the quality of the product, the payment assurance is very much in place. It is only we were trying to cover the time gap.
Mm.
But when it comes to ULI, which will essentially be, it will be a mechanized way of lending.
Mm.
But to my mind, the basic appraisal is not probably dispensed with.
Mm.
So after the basic appraisal, probably dispensing the credit becomes easier. And also for dispensing the credit, ULI will actually consume the data from the ecosystem and will be in a position to create algorithms which will be in a position to decide, guide the decision makers that
Mm.
whether they should go ahead or not. So I think, to my mind, it has addressed the timely delivery of the credit to a greater extent. But yes, small bit of appraisal in terms of the credibility of the borrower, etc., which should not be a very difficult task considering the kind of information which is available in the ecosystem. That will probably strengthen the underwriting practices. So I think it should not be a very difficult task. We have already seen that when we were doing actually KCC loans up to 1.60 lakh with the help of the
In
digital
Uttar
lending.
Pradesh, where was the pilot? It was
Uttar
a
Pradesh,
pilot,
Uttar
wasn't it?
Pradesh, Uttar Pradesh was done. So we have seen that it happens in virtually in few clicks with nanoseconds. It happens. So it's a reality. It can happen. But yes, of course, as I mentioned, the digital land records becomes one of the very critical component, and also availability of the GST invoices, etc., will be very, very critical. And some bit of an information relating to the borrower in term from the purchaser, etc. Those are the kind of from the ecosystem will have to pick up those that information. So it becomes a very, very uh, strong underwriting practice, and particularly for the low value loans, perhaps the cost of administering credit will also come down significantly.
Okay. Okay.
That is also there.
No, I'm worried about another kind of cost. If can we, are we right in even selling ULI like UPI? In UPI, I have the money in my account and I'm paying somebody. In ULI, you are trusting someone, you to measure the risk of the
Yeah.
person.
So that's why I
So
said that.
can we sell it as instantaneous?
No,
Isn't
it
it
is
dangerous to do that?
no, it is actually, if I may say so, it is when it comes to commoditization in case of UPI. UPI was merely transaction,
Exactly.
but it is something little beyond in terms of assessing the credit risk. And that's why I said that there is a lot of information which is available in the ecosystem, but perhaps it has to be put to a good use so that the algorithms can be created and decision can become very full.
No, my push is, should not bankers be saying, I will not give a nanosecond loan? My job is to assess the risk. I don't want to do it in nanoseconds.
No,
You should
assessment.
resist it, I thought.
I think as far as assessment of risk is concerned, banks will not probably compromise.
Okay.
That's
No,
what my
I
sense.
agree. Credit card is a loan, which is given literally in nanoseconds. But the whole system cannot be a credit card loan.
No, that is true. That is true.
So you are hoping that banks will.
No, I think that the basic
The
due
zeal
diligence
for
cannot.
ULI should not be more than the zeal for due diligence.
Basic due diligence will not be compromised. That's what my sense is.
Okay.
And even when we did the BRE model, we also never compromise on the basic due diligence.
Okay. That's good to hear, sir.
Yeah.
Now, let me come to an altogether different chapter, public sector banks. I mean, you have headed one and, uh, you know, completed your career with Elan. But repeatedly, the government has said we don't need 65% of the banking sector to be owned by the state. Uh, do you, I mean, and after that, all those arguments over the first 8 years of this government's term, the arguments have practically stopped. We heard nothing in the current budget, perhaps not even in the previous. You think that this is an agenda which needs to be mooted, that some more privatization is needed?
I'm a believer of ownership agnostic structures, whether it is private sector or public sector. When it comes to even entities like State Bank of India, where the government of India ownership is to that 56.92%. But if somebody asks me whether it impacts the decision making, perhaps no. So because it's a board run entity, and being a board run entity, it's a responsibility of the board to ensure that the policies are the one which are for the ultimate interest of all the stakeholders. See, when I'm talking of 56.92% held by Government of India,
No.
about 43% is held by various other stakeholders. And out of those other stakeholders, 12% is held by the foreign institutional investors also. So we are accountable to all the stakeholders in terms of the value creation. And that is one of the reasons why I feel that either it is private sector or public sector. More important is that the entity should be very focused. And we have also seen the situation where the accidents have happened in the private sector.
Hmm. Okay, let me put it this way. I read the Banking Companies Act some time back, so I will not be able to quote section and chapter. But the Banking Companies Act, Takeover of Banking Undertakings Act, does give the government, there are chapters and sections in it which give the government the right to uh, impose their policies, their programs. For instance, Mudra or Jandan, it can be imposed on the public sector banks. The act gives the right
But
which it cannot impose on banks they don't own. That's one. The second one, you will be bound by the CVC, the CAG, because the law of the land is that if you are a government entity owned more than 51%, all the three C's will be part of the working of the banking system. And then there is the Prevention of Corruption Act. Again, a very unfair act, because commercial decisions are not right or wrong. They are commercial judgment. Now, they do impede a banker who is circumscribed. So I would think there is a very strong argument. Yes, government needs, it has an SBI to impose its, to run its programs, and SBI ran Jandan brilliantly. But do you need 65% of the banking system to be curbed by CVCs? And surely some more space needs to be given to these banking entities.
well, there are two dimensions to the question which you have raised. The first dimension is to support the social banking program. Social banking program, government can always run through the public sector and private sector both. Because today, when it comes to social banking,
You definitely opened
it's a
way more Jandan accounts than HDFC or ICICI,
no,
sir.
see, the
I
point is
mean,
that
multiple times.
when we opened, probably people did not see the merit. But today, people can see the merit. Those are the accounts where today the average balance has gone to 4,000 rupees. So when we opened those accounts, it was perceived to be a cost. But we have already seen that about 4,000 rupees is a balance which is there in those accounts. And that is one of the reasons why today, when it comes to the private sector banks also, they're equally willing to open such accounts. That is one. Secondly, when it comes to uh, the SME loans or the Mudra loans, or for that matter, the CGFMU loans, we have seen that during the COVID, there was a equal interest from the private sector banks also. So I think it's more of an opportunity which is being perceived by the private sector banks, though the government has got they can certainly do some kind of uh, they may not be in a position to impose, but at the same time, they can have some kind of suasion, moral suasion on them. So that is something which you have
Moral
already.
suasion is perfectly
Yeah,
understandable.
yeah, moral suasion is something which you are seeing, and practically when it comes to the Swanidhi also, there was a active participation from the private sector banks. So we have seen it that I think over the over the period of time, the general perception that the social banking is not commercially viable probably is not the right thing to say. The second question which you said about the,
Administrative three C's.
yeah, three C's. So when it comes to, even when it comes to the private sector banks also, mm, one of the C's can always chase them, irrespective of the ownership structure. So I think it does not really make much of a difference to my mind, but nevertheless, it would be preference and also the policy preference of the government, which perhaps will decide the future ownership structures.
Fair enough. I agree with you that poor performance has been, found in all kinds of banks,
Yeah.
or uh, you know, outright bad performance has also been the lot of private sector banks. Now, let me look at the a big piece of infrastructure, something we discussed before we came up. The uh, the funding of infrastructure now can happen through private money because we have a large insurance and pension fund kitty, 115 lakh crore today, and total deposits is 200 lakh crore, 210 lakh crore. So the long term money is almost, and it's growing at 20%. Bank deposits are growing at 11%. So the gap will be bridged. Yet that money is not coming to infrastructure, or only 9% is in infrastructure, because they're clearly worried that the money may not be available when it is needed. The pensioner cannot be told, that I can't pay the money, I can't return the money to you. They stick to double A plus. How do you think this can be bridged? We have the money, but it is not going to where it is needed, which is infrastructure.
Yeah, when it comes to, perhaps the way forward would be the developed debt market in the country. And because as of now, when it comes to the certainty of the principal, which is very, very critical for the insurance sector as well as for the pension sector, though there are, when it comes to, when it comes to the pension sector also, now they have started permitting some investment into the equity and also some investment into the debt securities also. But yes, of course, perhaps some kind of a credit enhancement, so that when it comes to the I mean, chase for the triple A or the double A, that can become easier. So credit enhancement can perhaps be the way forward, which will probably facilitate such kind of money flowing into the infrastructure sector. Having said that, I must also mention that when it comes to infrastructure sector, we have already seen that the early success of the InvIT structures.
Mm.
So InvIT structure is the one where, at least where the cash flow positive, whichever
Yeah,
projects are now cash flow positive, they can be actually taken to the InvIT structure,
invest.
and out of that the money can be recycled.
Yes.
So that is one option which perhaps can be used in the intervening. And eventually, of course, the development of the debt market, maybe with the help of the credit enhancement, will also probably support the lending support, will
Mhm.
support the infrastructure financing.
I'm not very sure, but from what one infrastructure guy told me, InvITs are being purchased by Canadian pension funds, but Indian funds are still not buying InvITs. I'm not. I could be wrong, but this was what he said, that they have not made the leap. The Indian insurance
No,
companies.
actually, it so happened that when it comes to the pension money from across the globe,
Okay.
they were looking at the kind of returns which are sustainable over a period of time. And to that extent, the infrastructure which is being created in the country offers a decent opportunity. So it's not merely Canadian pension funds, but even the other pension funds across the globe also were showing a lot of interest, and some of the sovereign wealth funds also have shown interest. I think, to my mind, they were having a flavor from the different markets across the globe,
Mm.
and perhaps they had a significantly higher comfort. But now, of course, we are seeing the infrastructure within the country
Country.
also now in a position to really ride on this opportunity.
Okay. Yeah, let's hope that we are going to see more of this. Now, my final set of questions to you. I don't know if there are people in the audience who want to ask you. My final three questions to you is, what is your ask from the regulator? Now that the pen is down, you can boldly ask, where should they change? The first is the PCR, the LCR. liquidity coverage, new ratios? Do you think you need more time? Now it is not I need time, the system, or provisioning for infrastructure projects, project financing. What is your ask from the regulator on anything?
Well, when it comes to the liquidity coverage ratio, I think the system already has got the cash reserve ratio. And also, when it comes to the runoff factors, maybe they probably need to be revisited in the context of the Indian scenario.
So
Because
do you want them to
one
reduce
of
the ratios or give more time to reach the higher ratio?
no, I think perhaps it can be reduced also because as far as the Indian banking system is concerned, the concentration is not perhaps as high as it is seen in one of such cases, which was Silicon Valley Bank, where on the asset side as well as liability
Yes.
side, both sides there was a concentration. So that is some of the one of the reasons why perhaps the and that to my mind is one of the reasons why perhaps when it comes to the digital accounts, the runoff factor has been significantly enhanced. So I think maybe that can be revisited. That is what my sense is. And when it comes to the infrastructure related
Project
uh,
finance.
project financing and also the provisioning requirement, perhaps this can be more rationalized. That's what my sense is. And
5% is too much.
no, actually, it has to be seen in the context of the LGD
Mm.
in in
Loss.
in such cases, loss giving ratios in such cases. And if at all it is looked into in the context of the LGD, then perhaps it will be more scientific.
Mm.
That is something which I believe will eventually go a long way in terms of strengthening the system.
Okay. Well, I apologize for using those abbreviations. The Reserve Bank's recent rule is, I mean, it's still a draft rule. If you have too much of what they call unstable deposits, after all, we're all paying in UPI. So for the unstable deposits, you have to keep liquid. The banks have to keep liquid cash to the extent of 15%. At the moment, they keep 10%. They have to keep 15% of those deposits in cash, which is not really cash. You keep it in T bills, near cash instruments. That ratio has been raised, which is what we meant by raising of the LCR, liquidity coverage ratio. And you heard Mr. Khara's eloquent arguments on why it can be reduced or extended. A final question: where do we see you, Mr. Khara? What is
I
the next avatar?
I should be around.
Okay, so the government has approached you. That's very clear in that case. I think there would be questions. Yeah, you want to complete. Where do we see you? Do we see you in Delhi or Mumbai?
Maybe both the locations.
Okay. Yes, of course. We will be delighted. But anyway, Mr. Ajay Seth is coming later on in the day. We will probably get to know where we see Mr. Khara. Questions from the house. Yes, so please, if you can introduce yourself. My mic is available. Oh, it was not supposed to be for the house? It's okay.
Hi, my name is Vishal Sanghvi. I am a serial innovator and researcher, and there are so many new areas investment require. I want to know, like SBI has a lot of branch overseas. And normally they focus on NI deposit, but how you can make a new avatar, can merge with the investor in India, because there are a lot of our high net worth in US. They earlier it was service class, but after automation rise, there is a more era coming for the new entrepreneurship actually. So how this, this SBI
So what you're
branches.
saying in how will they tap NRI money to finance NRI investors, innovators? Is that what you're saying?
Yeah, and there are new ventures of money is possible too, not only for deposit actually. You know how you can see, because I cannot see, but you must be see the opportunity as a SBI branches to just getting those funding, not just a FD, but people just want to investment,
Tap
not for
global
the
money.
money, but a part of the India's growth story of Viksit Bharat. That's
In fact, about a year and a half back, we started startup branches. And those startup branches, we had set up about 5 startup branches across the country. And the intention of offering the startup branches was to ensure that we offer the solutions under one roof. And those startups, if at all they have to channelize money overseas, we should be in a position to help them channelizing that money as well. So this is something which we did. And when it comes to our overseas outfits are concerned, we are actually quite niche player in the overseas market, depending upon the opportunities which are available in those respective geographies. We do channelize NRI money, but not from all the pockets. So, but yes, of course, that money is eventually for the support of the economic activity in the country. And so again, it's a very varied model which we pursue in the overseas market.
I am KK Gupta from Research in India. So my point is the bank is losing huge money under the resolution IBC Act, IBC code you can say, for settlement of the accounts. Have any view on that? When you are settling the account under IBC, the resolution is there. So I think huge sacrifice being done by the bankers.
Actually speaking, when it comes to the sacrifice, certainly looks to be much magnified, because what happens is that when we file the case on the, actually we stop applying interest for quite some time as soon as it becomes NPA. But when we file the case with the interest which is applicable till the date. So for all purposes, of course, it's not a very prudent way of looking at it, but nevertheless, when we file the case, we ensure that we have 100% provision held against such assets. So now we have to see it in the context that when it comes to supporting such assets, what is the credit cost which we are required to incur? And as against that, when it comes to IBC, how we can have it resolved at the earliest possible. Well, I think there are different experiences across the globe, but knowing by what the IBC has been in a position to generate till now, I would say that the success of the IBC is actually the function of what the market is. When the steel was doing very well, steel assets could fetch much better resolution percentage. Similarly, when power sector started doing well, the power plants have started fetching much better value. But yes, of course, when it comes to EPC, etc., where there's hardly any tangible asset underlying, so there we have seen the challenge. So I think the experience perhaps cannot be put under this. But yes, of course, if at all we will aggregate everything, perhaps because that was a point of time when lot many EPC entities went through the IBC process, the overall number looks low. But if at all we will do some granular analysis, we will get to see much better realization also.
I'm told that we are out of time, sir. But you are an old friend, so you can carry on over coffee after.
I would say that leveraging analytics in a big way is going to be a game changer for the industry.
I think that will call for a discussion in its own right, how artificial intelligence is going to be harnessed. But a round of applause for someone who has contributed immensely to the banking system. We have
Thank
his
you.
word. He's going to be available in Bombay and in Delhi. So questions can be fired
Thank
for
you.
future occasions. All the
Thank you
very
very
best,
much,
Mr.
Latha.
Khara. Thank you.
Thank you for that extremely intriguing discussion. I request you to please step ahead for a photograph, both of you. Thank you, sir. Thank you, ma'am. Ladies and gentlemen, a quick changeover, and we will be ready to begin the next session, which is on FDI inflows, the big Indian opportunity. And let me tell you one more time that we will be having